there's companies that are saying, look, we're going to go ahead and drill the well. We're going to keep drilling wells, but we're just
Right.
not going to complete them. In my, like, maybe I don't understand why they would do that. And how is that even a solution, I guess?
Yeah, it's 100% viable. So there's a term for that, and we call them DUCs, which is, DUCS, which is drilled but uncompleted wells. And so essentially, a lot of times companies will kind of get in this situation to where, they'll sign a longer term rig contract, like a year, 2 years. There's even some 3-year contracts out there. But sometime during that contract, commodity prices just tank. And so when commodity prices tank, nobody's in a rush to get hydrocarbons to the market because you're just not getting maximum value for your dollar that you're spending, right? And so what they can do is drill the wells but not complete them. So essentially, you use your drilling rig, you go out there, you drill your hole, you run casing, you cement it, and then you just wait. And during that waiting time, you're just watching the market. And then whenever it looks like pricing is coming back up, or if your volumes are falling too much, there's a number of different reasons why you get a completion screw out there, and you go and frack the well and then produce the well. The
Got
benefit to this is that, roughly we can just say that half of the capex spent on a well is on drilling and the other half is on completions. And
it.
so essentially by doing that, you're saving about 50% of your capex. The downside though is that 50% of your capex is kind of sitting down whole, not making a return. And so you really have to play the long game right there. You've got to be patient, and everyone's got to be on board with the strategy because if those ducks start hitting the economics, it can look like a really bad return really quickly. The benefit though is that as soon as prices go up, you can get out there and get those wells online fairly quickly because oftentimes the production process is, fracking process is 2 to 3 weeks long, and then getting it online is a few weeks after that. So usually within 60 days or so, you've got hydrocarbons going down the pipeline.
Hmm. Okay. I mean, that makes sense, I guess. I think of it, it's kind of like an opportunity that's just waiting to be kind of completed or like realized, really, at some point. And I'm sure,
You'll
hopefully,
see.
investors understand that with these larger companies. I mean, some of the smaller operations, I mean, are they able to do the same thing? Or, I mean,
Yeah,
have you seen that be the case with companies that own less wells? Or
yeah, size definitely helps. So, when you're the super majors, I mean, having a few dozen ducks doesn't stand out on the books near as much as it does in some of these smaller companies. One of the other things though is a lot of your private companies that don't have to answer to investors. I mean, they're able to do that as long as ownership is on board and understands the benefits and the risks to it. If you're on either end of the spectrum, oftentimes it can work out. It's those ones in the middle that's really a challenge because investors like to see returns, and if returns go down, then they sell their stock, and the stock prices go down, and now you're in a really difficult spiral. So a lot of times doing these ducks, you know, reduces your capital spend. Hopefully, you can use some of that capital spend to retain people, and you're just waiting for that cycle to come back around. I think that's the other big hope there is that, it's not a long, 3-year depressed commodity cycle. Hopefully, within 6 to 8 months, things are coming back up, and you can kind of get back to standard activity. But really, it's just trying to lengthen the runway, before you have to make some really difficult decisions, personnel or otherwise.